Welcome to Tax Implications of COVID-19, Tax Attributes and the CARES Act, sponsored by the ABA Taxation section. On our program today, we have Eric Solomon. Eric is a partner at Steptoe & Johnson, LLP in Washington, D.C. Eric, you may proceed with the program. Thank you.
Thank you, Joanne, and welcome, everybody. The title of our presentation, as Joanne said, is Tax Attributes in the CARES Act. It's sponsored by the ABA section of taxation. This webinar is one of a series of COVID-related webinars presented by the tax section. Let me introduce the panel. We have Greg Fairbanks, Mireille Khoury, Danielle Rolfes, David Strong, and me, Eric Solomon. Greg is a managing director with the corporate tax group in Grant Thornton's National Tax Office. Greg is a former chair of the tax section's affiliated and related committee. Mireille Khoury is with the Internal Revenue Service. She's a senior advisor in the LB&I division. Danielle Rolfes is co-leader of the International Tax Group at KPMG. She was formerly International Tax Counsel at the U.S. Treasury Department. David Strong is a managing director in the Crowe LLP National Tax Office. He's one of the firm's leaders in the delivery of tax accounting services. And again, I'm Eric Solomon. I'm a partner at Steptoe & Johnson. Here are our objectives for today. First, to understand certain corporate tax provisions in the CARES Act. Second, to focus on the interaction of the CARES Act provisions with other parts of the code, particularly the international tax rules. And third, to understand the procedural aspects of refund claims and taxpayer elections. And we have three themes today. Our three themes are, first, the CARES Act corporate provisions are simple on their face, but unfortunately, they can be complex in operation. Second, much of the complexity arises from the interaction of the CARES Act provisions with other provisions of the code. And third, taxpayers are going to need to do modeling in many cases, modeling of the effects of the CARES Act provisions, including the interactions. In fact, because of the offsetting detriments that may be caused by the interactions, in some situations, taxpayers might decide to waive or elect out of the benefits of the CARES Act provisions. Now, as everybody knows, the CARES Act was enacted, signed into law on March 27th. It's roughly $2 trillion in economic relief aimed at businesses and individuals affected by the pandemic. We're going to focus on the provisions about corporate taxpayers in the CARES Act, and we're going to focus on the key attribute provisions of the CARES Act. And the main focus of these provisions is to provide liquidity to businesses affected by the economic downturn. At a very high level, the changes, the impact to corporations in the CARES Act seems to be relatively straightforward and three basic rules. First, changes to the net operating loss rules, allowing a 5-year carryback period for certain net operating losses, temporarily removing the rule imposed by the TCJA that limits the use of NOLs to 80% of taxable income, and correcting certain loss carryover effective dates. In addition, the CARES Act changes the AMT credit refund rules to accelerate credit refunds, and there are changes to Section 163J to mitigate the potential effect of Section 163J in 2019 and 2020. So with that, I'm going to turn it over to David.
Thank you, Eric. Advance to the next slide. So not by too much of a history lesson. So prior to TCJA, there was a rule relative to a 2-year carryback and a 20-year carry forward. With TCJA, it enacted removing any of the carryback provisions, so allowed for an unlimited carry over, but also with that instituted a limitation on the use of an NOL. So it was limited to 80% of taxable income. Really, I think this is more of a trade-off relative to lower tax rates and cash flow issues with the government. With that, the CARES Act was enacted, as Eric said, that allowed for a 5-year carryback period. So for tax years 2018, 2019, and 2020, taxpayers have the ability to carry those losses back for 5 aren't altered. So you go to the earliest year open. There is some interaction with regards to 965. I'm not going to cover those, but there is interaction with 965 that needs to be considered. Next area that I want to talk about is the refunds in general and the ability to provide some liquidity. So with the CARES Act, the focus was really on providing taxpayers with liquidity and getting cash back now, allowing for that carryback provision to really increase cash flows. So here the concept or idea is with that 5-year carryback, what I'm doing is I'm taking what would otherwise be a deduction in the 2018 in later years that's really taxed at a 21% rate, and being able to get cash back at a 35% rate. So a few things to consider as taxpayers are looking at filing carryback claims that are incurring net operating losses. Looking at the ability to file accounting method changes. So with the tax TCJA rules, a lot of companies were looking at doing some planning as it relates to accounting method changes. Those same rules really apply here because if I can increase a loss that I have the ability to carry back into a 35% year and recoup it at 35%, even the better. Some of the other considerations are the rules under 165I, where losses that are incurred in 2020 related to a disaster can be carried back or elected to be carried back into an earlier year. So losses occurring in 2020 can be impacting 2019. As that creates a net operating loss within that particular year, that loss can be carried back. So a lot of consideration in taking into account what potential method opportunities would be out there. One specific really relates to the CARES Act is the Qualified Improvement Property Fix. With that, there was a revenue procedure that came out, but here's where the modeling might come into play. So if I had qualified improvement property placed in service in 2018, I might want to amend that tax return, create a loss in that year, and then carry back that loss. Might want to file a method change in 2019 and do the same thing. Kind of taking all of my additional bonus depreciation associated with qualified improvement property and really increasing whatever loss I might have in 2019 by way of a method change. Or I might want to kind of take everything into account in 2020. So if in 18 or 19 I have taxable income, but by way of a method change or utilization of QIP, would reduce that down. It's a trade-off. Immediate getting the cash, potentially at reducing it at a 21% rate, or carrybacks at 35, or looking at 2020 and getting maybe the entire amount that I would claim at a 35% rate. So some of the other considerations, there are considerations on tax year end changes. So if I'm in 2020, consideration given to maybe changing my tax year to stop my tax year at a point in time earlier than December year end, and potentially be able to carry back sooner. I think the note there would be Revenue Procedure 2006-45 kind of governs the ability to change your tax year, so there are strict requirements in what happens. And in the year where you're generating an NOL, that does limit the ability to do those things automatically. As noted, there's a lot of interaction with the international rules that can modify or eliminate some of the benefits. Last bullet point is the CERT rules that primarily had limitations relative to a company's ability to carry back do not apply during the carryover relief, carryback relief. Move it to the next slide. So this slide illustrates the application of the rules and the 80%. As I said, with TCJA, there was a limitation or the ability to utilize losses only to the extent of 80% of taxable income. First example kind of walks through and looking at the tax years 2019. where I have taxable income of $200, the limitation also, results in an amount being due relative to only being able to offset up to $160,000. Next bullet point said with the implementation of the TCJA rules, there was some confusion or classification. So if I was a fiscal year company and had a tax year end that ended in 18, generally it scooped up that particular year, even though it might be a 2017 tax return, scooped that up in this limitation where I couldn't have the ability to carry back that loss. The CARES Act took care of that, so if I'm a fiscal year taxpayer where my year ends in 2018, I can avail myself of the 2-year carryback or the 20-year carryover rules as it relates to that. Slide. Advance the slide. Thank you. So with the CARES Act, generally the 80% was suspended. So what that means is for tax years 18, 19, and 20, these 80% limitations don't apply to the extent of I have a 2018 loss that I'm carrying into 2019. It's not limited by that 80% rule. That also applies to fiscal year companies. The example kind of walks through that illustration. The net impact here is that I get to fully utilize any loss carryover if it's within that 3-year time frame, generally eliminating any of the loss, and then any losses that remain get carried into 2021. Slide. So what that creates with this NOL carryover provision, so once I've kind of gone back and I've carried back all of my losses and I still have losses to carry over into future years, I need to understand, what's the character of those particular losses, because there's still post 2020, there is some interaction, be it pre-TCJA losses that would have occurred 18, 19, and 20, and then the losses that get carried over into the future. So a couple of different approaches. The first really presents it as I have the ability to wipe out all of my future income with carryover losses. There was an example in the Blue Book that kind of took a different approach relative to more of an ordering. So if I have $200 of income, I first take my pre-TCJA NOLs and I offset that income, and then my 80% limitation gets applied to that number. So here the net result would be in that ordering, create a tax liability. You can move forward to the next slide. So what that does is it kind of creates this new 2-step process that needs to be considered in 2021. Generally, the concepts of the Blue Book are adopted. So what I would do is if I have income in 2021, I would first look to my pre-TCJA NOLs that are carried over. I can use those fully to offset the income. And then I go through the analysis of effectively looking at, 80% of the remaining taxable income, or is the lesser of, or the NOL that I have from carryover from 18, 19, and 20. There is some interaction also with the 199A and the 50 and GILTI provisions. So generally, with that interaction, the 2-step process needs to be looked at, evaluated, and considered in determining taxable income post-2020. With that, I want to turn it over to Danielle to get a little deeper into some of the international rules.
And this is slide 16. Slide 16. Danielle?
Thank you, Eric. And I think the interaction of the international rules with that 80% limit on the ability to use the NOL is actually a bright spot. Because unfortunately, and something I think you'll hear us harping on throughout this presentation, the international rules that were brought forward in the TCJA are generally not at all friendly to companies that lose money. And that is in part because the Section 250 deduction that applies for GILTI and FDII, that is the only way to really achieve a reduced rate on GILTI and FDII, is to qualify for that Section 250 deduction that for GILTI is equal to 50% of the income. That deduction is scaled back to the extent GILTI and FDII exceed taxable income. So that is why I say it is a bright spot for some taxpayers that actually an NOL, an NOL, at least post-2021, NOL won't totally wipe out taxable income because that'll preserve a little bit of that Section 250 deduction. And that's what we see in example 1 on this slide 16. Here we have a taxpayer that had a lot of non-GILTI income, $1,400, before we get to the NOL, $1,400 non-GILTI income, a relatively small GILTI inclusion, 100. The key being the GILTI inclusion is less than 20% of that taxpayer's taxable income. So even though we have an NOL come in and wipe out some of that taxable income, we are still left with enough taxable income before the Section 250 deduction that we're able to get the benefit of our full Section 250 deduction, again, because taxable income exceeded my GILTI and FDII, and you have to determine GILTI and FDII here by the gross inclusions, not net of the deduction. If I shift over to example 2, here I see the harsh consequence where I had a very large GILTI inclusion. And because my GILTI inclusion exceeded 20% of my taxable income, I am, even with this NOL deduction, I am going to end up being affected by this limitation, and I'm going to lose a significant part of my Section 250 deduction. And as we note here at the bottom of this slide, this isn't just a timing issue. I'm going to permanently lose. There is no ability to recapture that sacrifice 250 deduction because of the fact that my GILTI and my FDII exceeded my taxable income. One thing I would just note on this slide that, as has been pointed out, the CARES Act sort of confirmed the JCT Blue Book treatment of these interactions of the 80% limitation. It also confirmed, I think, what the proposed 163J and the proposed Section 250 regs had already told us about the ordering to dealing with the fact that, both the NOLs and the Section 250 deduction were both subject to taxable income limitations, which presents the question of possible need to do simultaneous equations. The regulations that have come out interpreting the TCJA consistently reject simultaneous equations. We are never told in the regs to do a simultaneous equation, and in fact, those regulations told us to go ahead and compute the NOL taxable income limitation first, and then to take what's left and determine what is available for purposes of the 250 limitation. That ordering is, I think, unfortunate because your taxable income limitation when you determine 250 is going to be less than what it might have been if you'd taken the simultaneous equation approach. I will note that I think all of these, the proposed regs and the fix in the CARES Act to make this clarification are prospective. So maybe for these very early TCJA years, there may still be some room for the simultaneous equation approach as an interpretation of the pre-CARES Act statutory language in the TCJA. With that, I would ask Eric to push the slide to slide 17 and allow me just to get on my soapbox for one moment. There's not really anything new on this slide, so you can take a break for a moment from learning the CARES Act. This is just, this theme is going to come up throughout this presentation, which is the fact that GILTI, and it's also true of FDII, but I think it's particularly extreme when we talk about GILTI, how harshly it treats companies that lose money. And we've been saying this since the TCJA was introduced, but we didn't realize how important it would become until now. So it is a combination of effects that make the GILTI to be so pro-cyclical. And by that I mean, if you're in a recessionary situation, the way we are taxing the foreign income of U.S. multinationals is going to make that worse. And that is because we've already highlighted this point about the Section 250 deduction. But in addition, if you don't get your 250 deduction, the GILTI income, the foreign income being earned by your CFCs that for many taxpayers looks a lot like worldwide taxation, it's going to be taxed at a 21% rate because the deduction's not available. If you are in an overall loss, you're not getting that deduction. You're consuming your domestic loss or your NOLs that are otherwise a 21% asset. You're going to consume that tax attribute against your GILTI. It's effectively being taxed at a 21% rate. Moreover, and this is a theme we'll keep coming back to, a taxpayer that doesn't owe any regular income tax can't claim a foreign tax credit. Unfortunately, the TCJA, for some reason, has provided that GILTI foreign tax credits do not carry forward at all. So not only is your GILTI going to be taxed at a 21% rate, but that will be double tax. So the taxpayer might be operating, maybe this is a CFC operating in Germany paying very high German taxes. This taxpayer will be subject to German tax at the German rate and then again at the 21% rate on the GILTI inclusion from that CFC with no relief at all for double taxation. Moreover, to the extent anybody wants to, sort of fuss with me calling GILTI a worldwide tax system, we tend to point to QBI and the fact that under the GILTI regime, a taxpayer does get tax-free treatment for a 10% deemed return on tangible investment. But let me remind you that that's wiped out if the CFC is losing money. So it really is a worldwide tax system if you're not getting that deemed return because your CFC, because the QBI sits in a CFC that's losing money. And again, there's no recapture for that provision. So I think, where does this leave us? I think for companies that have domestic losses or NOLs, but they still have positive foreign income, and that's not a unicorn. I would say these are quote unquote the good taxpayers that maybe the U.S. has all the IP, the U.S. is the entrepreneur, and this good taxpayer operates through limited risk distributors abroad. It's to be expected they might have positive tested income. Those taxpayers should do whatever they can to accelerate deductions, defer income for U.S. purposes, to try to manage their GILTI to, be less than or equal to that deemed QBI return in order to not pay tax at a double tax at a 21% rate. And just in contrast, this is the last point I'll make, a taxpayer that's actually losing money everywhere or just losing money in their CFCs, there are no carry forwards. The GILTI is all an annual system. Those losses don't carry forward. Next year, I'm going to start fresh and say, do you have positive GILTI this year? There'll be no credit given for those deductions that exceeded the revenue in the CFC. Those are lost deductions. And guess what? Germany probably doesn't see it the same way. Germany has a normal tax system that's giving NOLs. So the taxpayer in that next year, they're not going to pay any German tax. They're going to pay 21% tax. Or maybe they get the benefit of the 250 deduction, but they're going to pay U.S. tax on those CFC's earnings, and they probably won't have any foreign tax credit because Germany does, the humane thing and gives an NOL carry forward. Maybe that's a little dramatic, but I can't justify these results and treatment of companies that are losing money. So I just wanted to we're going to keep coming back to it as we work through the implications of NOLs in the international rules, but wanted to set the table with that. And I think with that, we can move forward to slide 18.
Okay, thank you, Danielle. I'm told some people have a different slide deck, and so the slides are 5 off. So I'm on slide 18 now, which might be slide 13 for some of you that are looking at a different text. So, Danielle, just to focus on something you said, just at a very high level, the GILTI regime basically imposes a current U.S. tax at a lower rate on income of controlled foreign corporations. So there are people who have observed that GILTI, in essence, moves us to a worldwide tax system with a lower rate imposed on offshore income. So various people have made that comment, and in fact, ironically, it appears that we have moved largely to a worldwide tax system with different buckets taxed at different rates. So now moving on to, where are we today? Well, absent a waiver election, as we've discussed, there's now a 5-year carryback for NOLs arising in 2018, 2019, and 2020. And for calendar year taxpayers, NOLs in 2018, 2019, and 2020 go back from under TCJA of having no carryback. Well, now under the CARES Act, we have a 5-year carryback, and we temporarily have an unlimited carryover. Now, what's interesting about the CARES Act is unlike the 2009 financial crisis legislation, which allowed for optional 3 or 4 or 5-year carrybacks. And in addition, in 2009, in the financial crisis legislation, the IRS put out some complicated elections for consolidated groups for carryback elections and waiving carryback elections, and hopefully the IRS will resurrect some of the guidance that it put out for the financial crisis in 2009 with respect to waivers of carrybacks. Moving on to the next slide. The 5-year carryback has been pointed out by David can create rate benefits for carrybacks to 2013 to 2017 because they're carried back at 35%. And as David pointed out, various timing strategies might be considered. But one warning, and this is a warning that goes throughout this entire webcast, is that carrybacks can require recalculation of carryback year items, such as your 163J interest expense limitation for carrybacks to 2018 and 2019. It can also require recalculation of your Section 250 deduction for GILTI and FIDI for carrybacks to 2018 and 2019. For example, the use of an NOL carryback with a potential 21% benefit otherwise could be offsetting GILTI income that otherwise would be taxable at a 10.5% rate. Also, carrybacks can require recalculation of corporate AMT for carrybacks to 2013 to 2017. And also, as Danielle is going to point out and has pointed out, it could release foreign tax credits in prior years. So, big flashing light warning, carrybacks can require recalculation of carryback year items, including 163J interest expense, the Section 250 deduction for GILTI and FIDI, corporate AMT, and it could release foreign tax credits. On slide 16, which on paper, slide 20, on the screen, there's special rules for life insurance companies, and we're going to skip over that, and we are going to move to Greg to take over now. Greg.
Great. Thank you, Eric. And so for people keeping track, I'll try to clearly signpost. I know there's a number of questions trying to follow along. So online, this is slide 21 that should be titled CARES Act and NOLs Carrybacks. For those following off of an older deck, it was slide 16 of 50, I believe. So what we'll go through in the next battery of slides are some of the foundational odds and ends and potpourri items connected to the NOL provisions from the CARES Act. And then I'll be handing over to Danielle to go back to talk about the interaction of all of these provisions where the rubber really meets the road with those international provisions that really kind of make this a lot more complicated, and getting back to one of Eric's big themes, the need for careful modeling exercise to make sure you're maximizing your NOL usage and minimizing negative impacts on other parts of the tax apparatus. The first thing really is this idea of being able to waive your carryback. We have a revenue procedure 2020-24 that gives us the manner of doing this. Like most waivers, it's on a timely filed original return, but for tax NOLs arising in 2018 and 2019 years, we have an extension now. It's due, the election is to be made on the tax return ending after March 27th, 2020 for that tax year. So that means for your standard calendar year taxpayer, it's that 2020 calendar year return that's going to be filed in 2021. a little glitch here that we're waiting for probably some clarification from the service on. What does that mean for 2019? Does that really mean I don't make the election on my 2019 return and I have to wait a full year? If I don't make it again, is it somehow invalid? I think my personal feeling for now is, in the abundance of caution, I would make the election on my 2019 return, just like I would have on a timely filed return in pre-CARES years, and I'd do it again in 2020 just to put belts and suspenders on it. Also, we do note that you can waive skip over certain 965 inclusion years. That is also covered in the revenue procedure, and Danielle, I think, will touch upon that a little bit more in her segment. Our next slide, 22, is 17 at home. This is a little picture to kind of illustrate our three buckets of NOLs. So our pre-TCJA, our pre-TCJA NOL bucket, which is back to forward 20 and usable at 100%. Our relief year period from 17 through 21, the 18, 19, and 20 calendar years or corresponding fiscal years, where we now can go back 5 years, carry forward to infinity with a temporary suspension of 80% usage. And then the final bucket for tax years beginning after 1/1/2021, no carryback, infinite carryover, but limited at 80%. Our slide afterwards, now going to slide 23, titled CARES and NOLs Carrybacks, an example. So here's an example to tease out some of the procedural nuance in making a carryback election. Here we're positing a calendar year taxpayer has a sizable NOL, $20 million, on a short year return that ends on 6/30/18 because they're acquired by a buyer, and implicit in here is that they're joining a buying consolidated group. So they're going to make a final short year return, and because they would have made that before the CARES Act, they would have thought, well, my NOL doesn't carry back. It just carries forward. So I file my short year return showing a $20 million NOL. They join the buying group. And in the example here, we're supposing that after taking into account the Section 382 limitation on carryover of those NOLs due to the change in control, taxpayer uses $3 million of that NOL subject to the 80% limitation. Again, this is the buyer making use of the taxpayer NOLs under the TCJA tax law, being oblivious to the change that's going to be wreaked upon that by CARES on their timely filed original return. With that pre-existing fact pattern, our default answer now under CARES is first, the target, the buyer, is going to need to amend that post-acquisition tax year to undo the usage of the $3 million of NOL. That's not something that the service is going to do for you. You've got to do that to show now possibly a greater tax liability for that post-acquisition tax year. Then that NOL under the default rules must be carried back 5 full years. So you'd go back to 2013 and start using that NOL on a FIFO basis. Now, in terms of figuring out your refund and doing the actual paperwork, it appears that all that will have to be done on one or more 1120X amended returns as opposed to a Form 1139. And I don't want to go too far deep into this because we are a little bit time constrained, but there was relief provided on being able to file an 1139 for after the 12-month period by IRS Notice 2020-26, but that notice says that it's 18 months after when the tax year ends, which is all well and good for full 2018 calendar years, but for any taxpayer whose year ended before Q3, on or before Q3, 9/30 of 18, whether because they were acquired by a consolidated group and had that year close, or they might have done a elective change from a calendar year to a fiscal year. When you walk off 18 months, you realize that opportunity to file that 1139 has come and gone, and now you're back to having to file an 1120X. It's unclear if that was really the IRS's intent, if the point of the notice was to provide more plenary ability to use the 1139 to obtain a faster refund, but that's the way the rule appears to work as it stands right now. The next slide will now talk about this exact same example and what happens if we now choose to elect out of carryback. So again, the same fact pattern, we have to make that election by the due date of the 2020 return with extensions. They would then amend that post-acquisition tax return to reflect full usage. Remember, we're no longer constrained with 80% usage. We're in the temporary suspension period. We'll be able to use all 100%. We still have to bear in mind our 382 restrictions and how that might impact. And then the remaining NOL will carry into 2019 and 2020 without 80% restriction. If it still lingers beyond that, then we're into the 80% restricted realm again. And again, this is going to be all done on 1120Xs, not on 1139s for the previously mentioned sort of timing nuance of this example. Our next slide, after talking about our general carrybacks here, is how to do this. And for this, we've got notice 2020-26. Again, the scope and how this was written out was for a year that begins in 18, ends on or before 6/30 of 19. So it would cover that 18 calendar year and then cover fiscal straddle years. It doesn't apply to other attributes, just for NOL carrybacks. And as long as you file your tentative refund claim, your 1139, within 18 months after the close of the applicable tax year, you'll be okay. Procedure-wise, you state at the top of that 1139, you include the bracketed language there, and that's in the face of the notice itself. And to really speed things up, the IRS published some online guidance with the URL below that enables taxpayers to file their 1139s by fax to a dedicated fax line that opened up on the 17th. So that's currently live and available.
Yep, and Greg, let me just interrupt. Mireille, did you want to comment on this slide, on these procedures?
Yeah, sure. Yeah, I mean, as Greg shared, the Notice 2026 provides that extension for filing the 1139s. Last week, the IRS, as Greg mentioned, announced temporary procedures for how we'll accept the Form 1139s, as well as the Form 1045s that are filed pursuant to the CARES Act. As you probably know, the traditional process for these forms is they are paper forms. We only accept them through the mail. You mail them to Ogden. Ogden is currently closed, as are most of our campuses. But we're very mindful that taxpayers are eager to get these forms in so that the IRS can begin to process them. And so to address that, we developed a temporary process to receive these forms via fax. There are two different fax numbers, a dedicated line for the 1139, a dedicated line for the Form 1045. Once the forms come in, employees from our Wage and Investment Division are going to process the forms in a remote work environment. You'll see on the slide a link to an IRS site. This is where our FAQs are, about 14 FAQs currently, and I strongly encourage you to, if you're helping someone prepare an 1139, to check those FAQs and check back to make sure you're working with the latest, because they do get updated quite frequently, and they've been updated multiple times since we posted them last week, and they cover everything from file size limitations to how you should complete the form, what you should attach, etc. As I mentioned, the fax lines opened up last Friday, and we have since then started receiving submissions daily. One thing I will note is these are not general fax numbers. Strongly urge you to use them only for what they are for, sending in other forms. asking about where your stimulus payment is really just cluttering the line and doesn't get you the help you need. And that's all I have to say on that. Thank you.
Great. Thanks, Mireille. I want to emphasize something you said, Mireille. I know we are in, times where, and we really appreciate getting guidance out quickly. This is a note to people listening on the phone. It's a point you made. I want to emphasize it. If people are reading Q&As, they should check the Q&As regularly, because the people at the IRS are hustling to answer questions that taxpayers and their representatives have, and they are frequently updating those Q&As. And we very much appreciate the very fast guidance the IRS is putting out. But I do want to emphasize that we all should be checking the Q&As to make sure we're reading the latest Q&As. And then just a quick comment on what Greg was talking about. There are very interesting issues raised. For example, where one consolidated group sells a target subsidiary to another consolidated group, and then there are carryback issues. And the buying group might have expected it was buying a subsidiary that had NOL carryover subject to 382, and lo and behold, that loss is now available to be carried back by the selling group. And so you're going to have issues arising on stock purchase agreements where you have NOLs arising before the acquisition or NOLs arising after the acquisition. They're going to raise interesting contract negotiation issues, and one of the questions is, what did the stock purchase agreement say, if anything, about the use of those NOLs? So now we're going to turn it back to Greg. And Greg, if you would take us to the next slide.
Sure. So for those following along, this is slide 26 online. This is slide 21 on the paper versions, titled CARES Act and NOLs Carrybacks. As we go through the next set of slides, and being mindful of time here, this is going to be more cats and dogs issues. We're not going to be able to tease out a lot of the nuance, but by way of a side plug, a lot of these issues that, and Eric kind of touched on this, deal with consolidated groups. I'm going to touch on a couple issues that deal with the alternative minimum tax regime, AMTs, is kind of beyond the scope and purpose of this webinar. There will be a webinar through the DC Bar next Tuesday the 28th that will be going into a lot more details on the consolidated return and AMT interaction of these CARES changes. It's our same fact pattern here, and it's the middle bullet point is just to tease out, and is what Eric just touched on. A lot of these stock purchase agreements were likely silent or might have had incomplete language about what to do now that we're carrying back these NOL. My experience so far has been that this has been, a situation where the parties kind of have to come back to the table to figure out how you go about sharing or allocating out the refund that may be due through the carryback of NOLs, as the stock purchase agreement may have been silent on that. The last bullet point there, also to think about mechanically when you're doing all these things, the impact of the agency rules for consolidated groups under 1.1502-77. And also I would add in here, if you're going to be doing an 1139, to look at the procedural rules under 1.1502-78 that tells you how consolidated groups file their 1139s. Our next slide, slide 27, here we're looking at some of those AMT provisions. So that AMT, the $20 million that was generated in the short year, what happens from the carryback? Well, even though that was generated in a year where AMT no longer exists, AMT for corporations was written out by the TCJA, we do carry back to a year when AMT did exist. So that's going to necessitate now the taxpayer to figure out what are the AMT consequences in 2013 or 2014 and thereafter. That may impact the size of the total refund. There may be AMT credits that are generated, and then what happens with those credits that then carry forward, and credits that might still be around in 18 or 19 may now be available for refund under the CARES Act provisions that accelerates refund of that AMT credit. There's a lot of further nuance in here that I'm going to kind of gloss over. I just want to kind of tease out an important point to all of this is that a lot of compliance software was written in 18, 19, and thereafter to not do these things because they just figured, well, AMT doesn't exist anymore. So what I've observed is that some of the complexity here is just requiring mechanical calculations. The following slide, slide 28, if we can move there, talks about the procedural ways in which you do this. There are separate provisions that give a favorable extension to being able to use the 1139 to get your AMT refunds. The guidance does provide that you can use one 1139 to claim both your NOL refund and your AMT refund. You have to legend them appropriately on that one form. There's procedural aspects, there's due date aspects that I don't have the time to get into, but these are just things to bear in mind when you're trying to go through the processes of getting both your NOL refund and AMT credit refund. The next slide afterwards, here we'll be talking about briefly going on from AMT on slide 29. I'm going to really quickly go through this and just bear out an important point. This applies for consolidated groups. So a consolidated member that was not a member of the consolidated group in a prior tax year may have to look and see whether the carryback of the NOL is usable or not going back to its prior history, and that's due to the separate return limitation year rules, or the SURLI rules. And here we're positing that when the NOL of the target, and here is the reverse situation, instead of a standalone being acquired by a group, here it is a member of the group being acquired by private equity and is now going to be a standalone company afterwards. So that standalone company is now seeking to use its NOL in prior consolidated years. And the track for the unwary is that even though they were a member of a consolidated group, if that if the member didn't generate income on its own in those prior years, they might not be able to have that NOL usable by other members of the group in those prior periods. And the next slide, 30, kind of walks through that example. And in this is an example where even though the selling group had generated taxable income, the target on its own did not. It was a loss-producing member of the group, and so therefore none of the NOL is usable in the carryback periods. On the following slide, slide 31, now talks about just in general when you do these calculations, when you have to figure out the SURLI effects, you have to take into account all of the consolidated return rules that are kind of bullet pointed there at the end. Have you had a reverse acquisition? Have you had an offspring member or not? There's also predecessor and successor rules. Again, beyond the scope of this presentation, but presented here for the sake of fullness. The next slide, slide 32.
I think we need to skip ahead now. So we're going to skip over. I think the main point is if you're carrying back into a consolidated group, you have to worry about all the consolidated group rules to determine whether or not, in fact, you can carry back into the consolidated group and what limitations there might be. But with that, let's now, and I apologize, but we're going to move on into the international aspects of this, and so let's go to slide. Oops, one slide too many. Danielle, take it away.
Thank you, Eric. And I think the focus of these international slides is going to reinforce an overall message, which is that modeling is key. Modeling the impact of your carryback is going to be absolutely critical in particular because of the interactions of the carryback with the international provisions. So on this slide, I'm focused here on the interaction of net operating loss carrybacks with foreign tax credits. And we've already mentioned, you can't claim a foreign tax credit if you don't have taxable income. So when you carry back a net operating loss and you absorb it against prior year income, that may have the effect of now, because you've zeroed out your income, if you had foreign tax credits in that year that were previously claimed, those credits are now released and can carry back 1 year or go forward 10 years. An important point is if you end up claiming one of those credit carry forwards that was released by an NOL carryback, but you're claiming it in a year where you're not otherwise claiming NOL carryback, you're going to need to file a Form 1120X to claim those newly released credits. And, with all the baggage that an 1120X brings, including generally a duty to sort of true that amended return up for all the, law as it presently stands, which is an important point in the context of all the transition we've had with, major tax reform and a lot of uncertainty. Taxpayers may have filed returns where the law has evolved since. So those 1120Xs may carry more baggage than usual. Just a reminder here, you're not going to have this problem for GILTI foreign tax credits because those don't carry forward. So if you carry back an NOL to a year where you had claimed GILTI foreign tax credits, you're just going to lose those forever. So the other implication, in addition to the idea that now we're going to carry forward and release foreign tax credits, the other important foreign tax credit consideration when you carry back an NOL is you have to determine essentially the source of that NOL. Was that net operating loss comprised of domestic losses or foreign losses? And to the extent my NOL is comprised of domestic losses, I have good ordering rules in the regs that tell me treat that NOL as offsetting domestic income. And to the extent it's comprised of foreign, you treat it as offsetting foreign income. But to the extent, a domestic NOL offsets foreign income, you create an ODL account and vice versa. If foreign loss offsets domestic income, you create an OFL account. OFL accounts, overall foreign loss accounts, have to be recaptured. And so if in a subsequent year you claim credits because you thought you had foreign source income, you find out, I have an OFL account, I actually can't claim any credits. That's going to be detrimental to ability to claim credits in the future. Now, one little bit of good news here, those accounts are created in the case where an NOL is carried back, those accounts, even though, the extent to which that NOL created an OFL or an ODL, that even though that's determined based on the attributes of the income it offset in the carryback year, those OFL accounts that are going to hurt your ability to claim credits aren't created until the year of the loss. It's no earlier than the year of the actual loss. That's really good news because that means it's probably not going to creep in and mess with your 965 liability and the ability to claim credits in the 965 year. Just one other point, there are some interesting transition rules that are going to come up about, what if my current year loss is a branch loss? I lost a whole bunch of money in my branch. I carry it back and I offset foreign source income, in 2016, say, but there was no branch basket in 2016. It didn't exist. I also could have a GILTI loss because of expense allocation against GILTI stock. I have a GILTI loss. I carry it back. There is no GILTI in 2016. What do I do? I don't think the current regs answer that question, and I think we're going to have to ask the Treasury for help. There's concerning, if you just take a literal approach, real concerning language about the effect in those kind of sympathetic fact patterns I just described. And I think we need some new guidance from the government to help us with that transition question. So with that, we're going to turn to a really simple example. And in this really simple example, I'm focused, and Eric, if you could just move the slide forward. I'm focused here because I'm trying to avoid, after we finish foreign tax credits, we're going to turn over to try to deal with these 965 years, which introduce a lot of complexity. So for the moment, this slide is just going to focus on an NOL that just goes back and is fully absorbed in 2015 and 2016 so that I don't have to deal with my 965 year. And this is just highlighting that when I carry that NOL back to 2015 and 2016, I am going to ask myself what was that NOL comprised of? Is it a U.S. or foreign source loss? What kind of income does it offset? That's going to tell me what kind of, OFL, SLL, ODL accounts I have as of the end of 2020, the year of the loss. The other questions I'm going to have to now consider is, you saw I've wiped out my taxable income. I had FTCs that are now going to carry forward from 2015 to 2016. Maybe those FTCs will be claimed in the same basket. I do have transition rules in the final foreign tax credit regs that tell me how to transition If those are general basket foreign tax credits, maybe I want to transition and treat them as branch basket. Those are optional transitional rules, generally pretty favorable for taxpayers. But I'm going to have to work through the treatment of those foreign tax credit in a post-TCJA year, considering how I've previously applied the transition rules. But in any event, this taxpayer, not only did they fully offset all their income for 2015 and 2016, they now have this nice attribute, the foreign tax credit carry forward, moving into the year 2017, and we'll have to, hopefully those credits don't expire. If I flip now to my next example, where I've again tried to keep things simple and avoid my 965 year. So here I'm assuming I actually didn't have any income in pre-TCJA years, so I've carried back my loss in 2020 just to offset 2018 and 2019 income. And I had previously been allowed $12 of FTCs in each of those years, but they were GILTI FTCs. So here I'm just harping again on the fact that, to the extent, obviously I had some GILTI inclusion. I've now lost my 21%. I'm now being taxed at 21% effectively, assuming this NOL is a domestic NOL. This is an attribute that could have offset 21% income. It's instead offsetting my GILTI inclusion. I'm losing my 250 deduction. I'm paying double tax, and I have no FTC carry forward. So sort of very sad result here on slide 40 if you're looking at the screen, 35 if you're on paper. Now we get to 965 finally, and this is when things really get complicated. And taxpayers have to make a choice here, and I should start by highlighting that just moments before this webcast began, lucky me, the IRS released some new frequently asked questions on the interaction with Section 965, some of which confirm what I have on this slide, and at least one of which is going to tell me something different for a point on this slide. So, make sure you listen to me and don't just read the slide.
Just to interrupt just for a second, Danielle, just to make sure everybody's level setting, 965 is the provision that required companies to take into income previously untaxed E&P for pre-2018 years at a reduced tax rate.
Thank you, Eric. And now we have the further complication that the CARES Act, so for many taxpayers, we should say the transition year, it's going to depend on, it's the year that your CFCs, it depends on if you had 1130 CFCs or calendar year CFCs or if your fiscal year, but just big picture, some taxpayers' transition year might be a 2017 calendar year. It could also be a fiscal year ending in 2018, or it could be a 2018 calendar year, maybe because you had 1130 CFCs. If you had 1130 CFCs, 2018 would be your 965 inclusion year. You also might have both. There are a lot of taxpayers who had 965 inclusions in 2017 and 2018. And that is important because the CARES Act has introduced now, there's two different ways that we're going to handle the 965 inclusion years. First is the election. So taxpayers can elect to skip all Section 965 inclusion years as part of the carryback period. That the FAQs confirmed, sort of my reading of the CARES Act, which is that this is all or nothing, in that you can elect to skip all your 965 years. You can't pick and choose. If both 2017 and 2018 were 965 years and you think, well, I'd really kind of like to carry back to 2017 because I like that 35-21 rate arbitrage I got for 2017. But for 2018, I don't want to carry back. No dice. It's all or nothing here. You get one choice of skipping your 965 years. And that is a deviation from what we have already told you in this webcast, which is that otherwise the 5-year NOL carryback is all or nothing. So this is a nice ability to choose, but it is definitely constrained. If a taxpayer doesn't choose to skip the 965 year altogether, then the statute, the CARES Act statute, has told us that taxpayer is going to be deemed to have made a Section 965N election. And for those that didn't closely follow Section 965, the effect of the Section 965N election, and here it's mandatory, is that it effectively walls off that 965 inclusion so that it cannot be offset by these NOL carrybacks. That is, this is great, we have a 5-year carryback, but under no circumstance is your carryback going to be allowed to offset your 965 inclusion, because even if you don't decide to skip the year, the government has decided for you that you're going to skip the actual 965 inclusion. Now, that doesn't mean your 965 inclusion isn't going to change, because I've already told you that FTCs might be released, foreign tax credits might be released from an earlier year because of carrying back to an earlier year. If those flow into a 965 inclusion year, they can offset the 965 inclusion. So I might still need to do some recalculations. Now,
hey, Danielle, but it's not necessarily all bad that the government has imposed this on taxpayers, because forgetting the foreign tax credit implications, it may be that you're happy to pay tax at whatever the reduced 965 rate is, rather than to use NOLs, for example, that would otherwise be used at 21% or 35%.
You've got your 965 deduction. So 965C gave you the deduction. That's not taxable income limited like the 250 deduction. So I actually don't think the government is doing you that favor. I was always going to get the reduced rate is achieved through a deduction. That deduction varies depending on whether your 965 year was a 35% year or 21% year. But I think they're not doing you any favors on that front. Now, maybe I'm missing your point, because... No,
why don't you go ahead? I apologize for the interruption. Please keep going.
I have had to work through that myself, Eric, so don't you... I mean, I have struggled with that when 965N was included in the tax reform in the first place, and said, why would a taxpayer want to wall off their 965 inclusion, given what I just said, which is it's not like that's the only way to make sure you don't use a 21% attribute against it, because you would only apply the 21% attribute or the 35% attribute if we're talking about 2017. You'd only apply it after taking into account the deduction. I think in many cases the appeal of a 965N election was because there were expiring attributes, like a foreign tax credit carry forwards. This is, a last big slug of foreign source income, and I would otherwise going to lose those attributes. So that's one reason. Just one thing to note about 965N as it existed in the TCJA, there were actually two aspects to it. If you were carrying back a 172 deduction, you could decide, I don't want to offset it. I'm going to skip the 965 inclusion, and so I'm going to still pay tax. But there was another aspect included in in TCJA, which is that a current year, you could shelter your current year and decide, I had a real big 965 inclusion, but if I didn't take that into account, I would have had a loss. If you made a 965N election under the TCJA, you could actually create a current year NOL by having done that, or you could increase a current year NOL by having done that. Now, importantly, and this is really important, and we might be looking for the government to give a little relief here, but importantly, the CARES Act has told us this new rule about deeming a 965N election, it only applies to the carryback. If you had to make the TCJA, you had to make that 965N election that could also have that current year effect, you needed to make that on the original return filed by the extended due date in order for it to have that effect. And so far, the government has said that there's no extended time to do that, that if you didn't make a 965N election for, say your year was 2018, is when you had your 965 inclusion, you did not elect 965N for 2018, then although you're going to be deemed to have the election apply for purposes of carrying back, for example, the 2020 NOL, you are not given a second bite at that 2018, the possibility of maybe creating an NOL in 2018. And gee, isn't that unfortunate now that I just learned that my 2018 NOL might have gone back 5 years? And is that fair? Because I didn't know the stakes when I passed it up. The stakes were different. But so far, the government has said you are stuck with your original choice. I've noted here on the slide, I think there's some inequity in light of the fact that the stakes have changed so much, and I would expect taxpayers to be sort of begging for another bite at the ability to make that 965N election if it's a year, if 2018 was a 965 year. Really important point here. Here's a reason why taxpayers might want to skip applying an NOL to a 965 year. The government has previously told us, this isn't new, but they've told us that if you have any change to the return that included a 965 inclusion, you cannot get a refund for that year unless and until you have fully paid off your 965 liability. Yes, we have this wonderful installment plan for paying 965 under 965H. We have an installment plan, but the government has interpreted the statutes that they don't have the authority to give you a refund if you still owe installments. So that is a big reason taxpayers might want to skip the 965 year and not apply the NOL, because maybe they won't be able to access a refund. So with that, we're going to turn here to the next slide and just do a quick example. This slide is just kept simple, and it's just showing you the effect of the 965N election. It's basically, we have here a taxpayer that lost $5,000 in 2020. They carry that NOL back. It offsets all their income from 2015 through 2019, including their regular tax liability that they had in 2017, their 965 inclusion year. But it was not, because the government has told us, deem 965N election. This taxpayer is still, stuck. It cannot use that NOL to offset the $300 of tax that was owed after taking into account my 965C deduction. So I cannot now. However, do note, and I also can't get a refund until, even though I used some of that NOL in 2017, I can't get a refund unless and until I fully paid off that 965 inclusion. But I do note here that I think I may have, because it looks like since there were no FTCs for this taxpayer, they had paid $350 of tax. So after we've taken into account all the installments and the taxes that have already been paid for 2017, I think this taxpayer may actually get a 2017 refund, because it looks like they'll have fully paid off 965. Now, if we flip to the next slide, we're introducing foreign tax credits into the scene. And this slide, I'm not going to belabor this slide. It just highlights, and Eric, can you push the slide forward one on the screen? This next slide just highlights, it's just a little slow. Sorry, I'm being impatient. You told us earlier you were impatient. I'm impatient too. This next slide just highlights that even though my NOL can't offset my 965 inclusion, here this taxpayer, because the NOL did release foreign tax credits, those foreign tax credits have carried into my 965 year. So the 965 inclusion is actually reduced by the FTC carry forwards. And here again, I've elected not to skip the 965 year. So again, I think I'm owed a refund. Actually, even though I'm no longer going to get the benefit of my installment plan, I have to fully pay it off. My refund's not as big as it would have been if I'd carried my loss, and taken it in other years. But that said, I've used that $1,000 loss against 35% income. If the taxpayer isn't desperate for the cash, that might be the right decision. The other thing to note on this slide, when I carried my NOL into 2018 and 2019, I totally eliminated my $250 deduction for any GILTI inclusion I have. This slide assumes that my FTCs there at the bottom have also been eliminated because they're GILTI taxes. So actually, I think this taxpayer made the right call in deciding not to elect to skip the 965 year, assuming they are not desperate for cash. They have benefited from using their NOL as a 35% attribute. They are getting a little refund because they've gotten some relief on their 965 tax, and they've avoided the permanent loss of the 250 deduction, the permanent loss of the credits. Definitely the right decision for effective tax rate here. This next slide summarizes what I have already said. So this next slide talks about to waive or not to waive, and it's just kind of a litany, and the bottom line is you're going to have to model it. You're especially going to have to model it if you're a taxpayer that have 965 years that are both 2017 and 2018. Because you can see, you might want to skip a 2018 965 year because 2018 you may get whacked on your 250 deduction. You may have a beat implication from claiming it. All kinds of adverse TCJA consequences of zeroing out taxable income in 2018, but for the 965 inclusion. Whereas if it's 2017, I love the rate arbitrage, but on the other hand, I still can't get a refund. So I think this slide just sets out what I've already said about considerations that one is going to need to make, and the bottom line is that you're going to have to model it. And I think that brings me to just my very last 965. Is it really my last? I guess this next slide highlights where I do skip the 965 year. I skip the 965 year, and I don't think this is rocket science, so I'm just going to keep moving on. Even though I've skipped the 965 year, I guess the one thing to highlight is just I did still release FTCs. So I skipped my 965 year, but this reminds me of an important point to make, and it relates to the FAQs. So I'm sorry, Eric, I have decided I'm going to hang out here for a minute on this prior slide.
Should I go back one on this one?
Yeah, go back one. I'm sorry.
That's okay.
I have reconsidered now, and I think it's important that I highlight the fact that, first of all, these slides told us, if you look at the instructions to the Form 1139, they tell you that if you carry back an NOL to a 965 year, that you cannot use the Form 1139, and you have to file the Form 1120X. So not only can you not get a refund until you fully paid off your 965 liability, but you would have had to wait all the processing time for the 1120X and all the baggage of the 1120X. The FAQs that just came out, hot off the press, tell us that in fact I can use an 1139 and I can disregard those instructions. So isn't that pleasant relief from the IRS, since obviously the 965 years are in the heart of this 5-year carryback. So that's fantastic news. There is also an FAQ, FAQ 10, that highlights sort of what's set up on this slide, which is I skip my 965 year. So I'm not filing an 1139 for my 965 year on this slide because I decided to skip it altogether. I need the cash, man. Even though I'm giving up the 35% attribute and I'm instead taking that NOL, 1 year further into my post-TCJA years where it's only worth 21% and I lose $250, I am so desperate for cash. No, I'm sorry. Yeah, this taxpayer has decided to skip it. I am not so desperate. I'm desperate for cash. That's why I've skipped it. I'm hurting my ETR by giving up the 35% benefit because I need the cash. I've got to get the refund. So I'm not filing an 1139 for 2017. However, I've had these FTCs get released and push into 2017. The last FAQ highlights that I need to, bottom line is I'm going to strongly encourage you to file an 1120X to get the benefit of recalculating the 965 liability to take advantage of those FTCs that have now slid into 2017. Because the government warns us, although they don't quite say you have to file an 1120X, in general, you have to file an 1120X to claim the benefit of released foreign tax credits. And the government warns us in that FAQ that you're at risk of having your installments accelerated, just as an administrative matter, a matter of systems. I think everybody would just strongly encourage you to file the 1120X to take the benefit of the FTCs that have now slid into 2017. Okay, I think with that,
I think what we should do now, Danielle, I guess the real message here is you got to do some really hard thinking whether or not you want to elect to skip the Section 965 inclusion year. I mean, that really comes out very, very strongly in your remarks. Do you want to talk about BEAT and NOLs?
Yeah, and I'll say the last thing that was just on the 965N thing, we've highlighted that about the sadness of wanting to reconsider my ability to take that election in 2018. So I will turn quickly to BEAT. And you know what? I don't have much to say. Because the BEAT statute really lays out the harsh consequences here. And it's just a reminder that a taxpayer that is claiming an NOL, if it's a post-TCJA NOL, you need to determine the base erosion percentage of the NOL. That base erosion percentage is also going to be a BEAT add back. And we've always made the general statement that taxpayers with low taxable income are more vulnerable to BEAT, and that remains true. Slide 43, I had thought I might have more to say because I had thought a general theme might emerge as I kept working through these numbers. And I'm sorry, it's 48 on the screen. No general theme emerges. The general theme is that BEAT has a random effect on companies with losses. The only general theme I can say is if your base erosion tax benefits, including the base erosion percentage of any NOL add back, is less than the loss, you won't owe beat, and that's kind of like a freebie. And so I think if you're running a loss in a current year, and you also, if you're going to carry the NOL, in general, the NOL tends to get discounted a little bit in the way the beat calculation works. It may be worth considering whether you should accelerate some base erosion tax benefits into that year, especially because if you're not an applicable taxpayer, like you don't meet all the thresholds to be a beat, to be having to do the beat calcs in the year you carry the NOL, it won't even hurt you. But a bottom line, you can look through these slides. It's a random walk. It's just random. I can't explain it. So maybe with that note, I will turn it over to talk about AMT and 163J in the few minutes remaining.
Well, thank you, Danielle. I mean, you know, your discussion really tells us these carrybacks are very complicated, and you really got to study the interactions with foreign tax credits, with Section 965, and with B. And if you've got those potential consequences, you better think about them when you're thinking about your carrybacks. Let's move on to the AMT credit. And David?
Yes. If you want to move it to the next slide. And
I certainly will.
Perfect. And again, I'll try to cover this at an extremely high level, not to spend a whole lot of time on it. But generally, the CARES Act, what it did is really accelerated a taxpayer's ability to get back AMT credits. The general rule prior to the CARES Act was that taxpayers were going to ultimately get that back as a refund, but it was staged over several years. So the CARES Act generally accelerated that, allowed taxpayers now to claim that credit and get a refund in 2019. If you want to advance it to the next slide, that would be great. So as Greg had alluded to, you know, it can be done as part of the 1139 carryback, you know, process. So I think here it's the main thing of making the decision relative to do I, you know, file my tax return in 2019, claim the benefit, you know, there, get 100% back in 2019. I think with the interplay with the AMT NOL rules and everything else, you know, the other avenue would be really if I'm not necessarily filing my 2019 tax return currently, and I'm, you know, filing a carryback claim related to a 2018 NOL that now is freed up and I can carry it back. You know, I do have the ability then on that 1139 to effectively accelerate the refund and do so in the 2019 or 2018 year, so to get that full refund. So I think you know, same thing relative to the other 1139. There are frequently asked questions that address that. So I think here the key issue is really the timing of, you know, how quickly you want to get that refund back, the timing of filing the 2019 tax return, and the timing of filing your 1139 all need to be kind of taken into consideration. If you want to move to the next slide. Some other considerations here. So with first bullet point, really, so if I have a situation where I might have gone out of existence in 2019 and I'm not really, you know, filing a 2019 tax return, basically this gives me the ability to then, you know, claim that refund with, you know, the carryback claim and the 1139, or claim it in that earlier year. Some other provisions for consideration: the complexity that relates to you know, consolidated groups and AMT credits need to be considered. Then also the implications related to the short tax years and how those might factor into carryback claims and carryover claims. So I think the overall theme here is that you need to at least kind of take into consideration, kind of model it out, you know, how quickly do you want to access that cash and get those refunds back, and then pick an avenue that allows for that. With that, I'll turn it back over to Greg to cover 163J.
Thanks. And if we can advance, there we go, slide 52. So this is titled CARES Act Changes to 163. And in our couple of moments here that we have left on this call, just thematically, going back to the issue of what elections are in play in our modeling, for NOLs, we have, you know, possibility 1, I carry back the NOL all 5 year. Possibility 2, I waive all carryback. Possibility 3, I do carry back 5 years, but I skip for 965 purposes. So that's sort of the NOL elections. For AMT, I can have the AMT credits refundable over 18 and 19, or I might elect to have it all in 18. And we've gone through a fair amount of detail on how these various possible elections interact with some of our international provisions. Our final new piece of CARES changes is for our disallowed interest provisions under 163J. And what CARES has done is that instead of having the limit on deductible interest based upon 30% of adjusted taxable income, or ATI, that 30% is increased to 50% for tax years 19 and 20, ostensibly to allow greater usage of interest expense deductions. However, taxpayers may elect to not apply the higher limitation and instead have a lower limitation. Also, there is an election to be able to peg the 2019 ATI amount for your 2020 tax year, and there is a revenue procedure, 2020-22, that gives us guidance on this. The next slide talks a little bit on 53 about partnerships, and I'm going to skip over that to kind of go to our closing thing to layer one more level of complexity here, is now what effect making possibly these 163J elections can have when considering the impact of 163J and BEAT. That's our base erosion tax. So I'm going to hand this back to Eric to close us out, to walk through those slides, and that kind of, I think, puts a nice bow on these various moving parts that, again, really emphasize how much of this is a modeling exercise.
All righty, thank you, Greg. I'm just going to do the last two slides, which is just about the interaction of 163J and the base erosion anti-avoidance tax of Section 59 Cap A. And this example just shows the theme that we've been discussing over and over again, which is the interaction of all these provisions. As Greg pointed out, the change to 163J in the CARES Act says that the limitation, which under TCJA was the limitation for interest deductions was 30% of adjusted taxable income, is increased to 50% of adjusted taxable income for 2019 and 2020. So, at first glance, you'd say, hey, that's great, because now I can use more interest deductions in 2019 and 2020 because my cap on interest deductions has been increased. So that's what slide 54 shows us. But slide 55, our final slide, says, wait a minute, we better think about some interactions, because what happens is you have to do the calculation. If you have some cross-border payments, you have to do a calculation under BEAT, because BEAT is like, in some ways, a different kind of alternative minimum tax. It adds tax to the regular tax calculation. And so if it turns out that the additional interest expense that you think you're going to get to deduct are comprised of base erosion payments, what may happen is that you're allowed more interest expense deduction for regular tax purposes, which reduces regular taxable income, and it reduces regular tax liability. So you think you're really well off because you now have more interest deductions. But in some cases, this benefit can be offset to some extent by increased BEAT liability under this alternative tax calculation under BEAT. So once again, you're going to have to think about that interaction if you have cross-border deductible payments. When you do the 163J computation under the new 50% limitation, you may have to think about, well, maybe I don't get the full benefit I expected because then I'm going to have an increased BEAT liability. And so, a similar point throughout the discussion we've had today, the point is, for example, you release foreign tax credits because you use NOL carrybacks. Well, you better check out your BEAT liability in post-2017 years, because now the release of foreign tax credits could affect your BEAT liability. So with that, we keep saying the same thing over and over again of the complexity of all this. The CARES Act provisions appear to be relatively straightforward, but in actual operation they're complicated, and you're going to have to do modeling to understand the interactions, because in some cases you might want to waive or elect out of some of these benefits. On the remaining time that we have, what I'd like to do is take a couple of the questions that we have received. Here's one question that we've received towards Greg. Here's a situation where Target Corporation was a standalone corporation, and it was acquired by a consolidated group, and it was acquired, let's say, in the middle of 2018. So there's a stub period, as standalone stub period, and there's a loss in the stub period. And it hasn't waived the carryback on the 11/20 stub period return. And let's just say under the stock purchase agreement, the seller is entitled to tax refunds for pre-acquisition years. And the purchasing group thought it was buying a Target with an NOL carryover subject to 382. And so what do? Because how do you do the waiver? Because this was a standalone corporation before its acquisition. It wasn't in the consolidated group, so it appears to me that the -77 rules that would make the new purchasing parent the agent for the group doesn't apply. Would it be possible, do you think, to waive the loss for the pre-acquisition stub period when the company was a standalone?
So I think, Eric, is it possible? Yes. But I think procedurally, it's very important to not make footfalls, and you really have to look at the state law on who is the proper officer of the target, because they're the ones that have to make that election. It may be in a lot of times that after the acquisition, the president of Target may very well be an officer of the buying parent as well. It's just important to make sure that the election is being made by the proper officer in the proper capacity as the agent of the target. I agree with you that the agency rules under 1.1502-77 of the Consolidated Return Rules, they presuppose that you have a consolidated return tax year. In this case, you don't. You're talking about a prior year that was a standalone. So I don't think any of those rules are on face applicable. There is an example in there, -77G example 2, that I think is helpful because they mention in that case was one group to another group. They mention that the old group common parent is still the person responsible for those prior years, even though they were acquired by the buyer. Similarly, it's still the target that is responsible for those old prior years. So it's the officer of target, and the officers may have turned over, things may have changed, but you really got to be looking at the target and asking who's the proper officer of target. But I would say that for that, you want to really look at your state corporate law to make sure you're tagging the right person. Eric?
Like Eric's on mute, but Gregory, is there any issues with like 382, 383 as we kind of go through this process of what things to consider?
Yeah, I guess a final remark before I'll turn it over for completely being closed. Danielle brought up a lot of really good points about going back and creating foreign tax credit carryovers. We talked about going back and creating AMT credit carryovers. All of these things can expose a company to being a loss corporation earlier than they may have anticipated, and it could result in having ownership changes that may impact those carryover of those tax attributes. Your foreign tax credits now being freed up in prior years, or AMT credits being freed up in prior years. And that gets into a whole other level of complexity, but it's just another thing to have to sort of tick off in your toolbox before you try to conclusively determine what's the best set of elections and rate arbitrages and when you choose to time items of income and expense to get the best answer possible for your company.
Here's a question that we received. I'm just trying to go quickly through the questions we received. You know, in the 2009 crisis, there was a provision about cancellation of debt income and how you could spread it over 5 years. Has anybody heard of a discussion of that possibility as part of the next legislative effort?
I'm not yet.
Yeah, I've heard discussion among practitioners, but I haven't heard anything said by government officials, legislative government officials on that point. Another question we got is, do you think that the next bills being taken up might contain some fixes to the CARES Act provisions or modifications to the CARES Act provisions? My reaction to that is, unless there's something glaring, I think the focus will be on other areas of assistance. All right, well, I'm quickly going through the questions here. We'll take a look at them afterwards. I want to thank our panelists for all their hard work on putting this together so quickly and identifying so many issues that are involved. Again, our themes have been that the provisions are simple on their face, but they're complex in operation. There's a lot of interaction that's going to require modeling. So I want to thank Greg Fairbanks, Mireille Khoury, Danielle Rolfes, and David Strong for their efforts here, and we want to thank our audience for being with us for this webinar. There will be more webinars on COVID-19 related issues. Thank you again for joining us this afternoon.
Thank you, Eric. On behalf of the American Bar Association, the ABA Taxation Section, thank you for participating in this program. To learn more about the sponsors, visit the ABA website at americanbar.org. Thank you, and please click on the evaluation link. We value your feedback.